Good day and welcome. I'm delighted to introduce our host today, Angela Bolton. Angela is such a go-to expert on all things fixed assets management. She really brings a wealth of knowledge and experience to everything she does, really. She's passionate, and you'll hear that immediately. Angela is going to guide us through year-end best practices. She's helped hundreds and hundreds of customers, and she's lived this every day. So what she says is real world. This session is really designed to meet you where you're at and help you move forward with confidence. All right, Angela, good morning. Welcome, and let's dive in. Over to you.
Good morning, Tawny. Thank you. And thank you for everyone's time today. I know that time is precious to us in our workday, and I appreciate and I'm very grateful for you to be here today to talk about year end and all things fixed assets. As Tawny mentioned, I am so passionate. I've been doing this for 27 years, and I don't know why, but I'm just this kind of a weirdo who really loves this subject. And as we'll move through these slides today, I will throw in some real world examples because fixed assets are always interesting. They're always challenging. There's always different things that move throughout its life cycle, depending on the business, the industry, the size, if there's multi-locations, global or domestic. There's always different nuances that really make me scratch my head as a true problem solver and understand all of the different ways and intricacies about how fixed assets move throughout our day, move throughout our business and our organization, and just how spread out this subject really is that people don't really understand. And that's what we're going to go through today. So I just want to start off by grounding ourselves in the why we're really here and why we're talking about fixed assets and their year-end processes, because studies show that nearly 43% of small businesses and medium-sized businesses also don't effectively track or inventory their fixed assets as they should. And many more simply just deprioritize fixed asset management and the life cycle of that in its entirety altogether. And that stat in particular comes from Go Codes, but it doesn't really matter where that's exactly from because it's from all different sources. And I've literally seen it play out firsthand across all industries over all of these years of practicing within the fixed asset realm. So this slide looks a little silly, but you'll understand why. I wrote an article about a year ago talking about different systems within our landscape of ERP and different niches of different subjects. So you have your front office, your back office, and within the accounting ERP world, you have all of your core competency modules, right? AP, PO, GL, so forth. And then you have fixed assets. So I want to talk about this a little bit because in the enterprise asset management market, the enterprise itself is projected to nearly double by 2032. And what does that mean? That means there's a lot of fixed assets and capital being spent soon. So big companies are also investing in smart tracking, depreciation forecasting, and automation. But the small to mid-sized organizations are a little behind. They're still duct taping spreadsheets together and at year end and hoping it passes audit, that it's reconciled, that it's okay to pass on to tax, property tax when that rolls around, and so forth. And so when we're talking about priorities, HR tech is booming, right? So payroll benefits onboarding is fully integrated, well-funded in the tech space, but fixed assets is still being treated as an afterthought. And that's a little strange to me still. So I call it the candy corn and the garlic bread syndrome. So there's two things that just don't belong in the same system, yet they often are. And that's why we're here today, because fixed assets are quietly sitting at the center of your reporting, your compliance, your tax world, and other pieces of your business. And the longer we ignore them, the more tangled the web becomes. I wanted to bring up my analogy of the spider body with the fixed assets. So let's move on down this journey of broken processes across different departments. So let's talk about what happens behind the scenes of most fixed asset operations. And just so you know, everybody has fixed assets. Because what I've found time and time again is that it's not just that the data is messy. That's one piece of it. But it really comes down to processes, and you're going to hear me talk about it a lot, the word communication between departments. And that's where things start to fall apart. So here's the metaphor that I've already mentioned that I love to talk about. We went a little overboard on this fun little analogy just to make fixed assets fun. So the fixed assets are the body of the spider. That's where all the assets are. That's where they sit in the center. They sit silently with foundation, and they hold everything up. But this body isn't floating in space, is it has legs. So it has 8 of them, in fact. And each one of those legs represents a different business function: accounting, tax, procurement, project management, audit, and more. And here's the truth of it all, is that when even one leg breaks on this spider, everything connected to it can suffer in different ways and aspects. So if procurement forgets to tag or flag an asset, for an example, accounting may never capitalize it. And if the tax team doesn't get accurate placed in service dates, your depreciation schedule is already wrong before it even starts to run. So if GL reconciliation isn't clean too, then your financials are exposed. So the problem isn't that one department is doing it wrong. It's that no one owns the whole spider, the body. Not everyone is communicating for these fixed assets. So it gets caught in the middle of silent systems, disconnected teams, and the year-end pressure builds because of it. So today we're going to walk through each one of these legs of this spider body of fixed assets and how to get them working together cohesively as in one community so that the body stays strong, stable, and supported in all different ways and functions within your organization. So let's explore these 8 legs in detail, but not too much detail because I don't want to bore anybody. So these aren't just theoretical touch points that we're talking about. They're actual processes and people across your organization every day who can influence the integrity of your fixed asset system, whether they realize it or not. The first leg of this spider is accounting and GL reconciliation. This is the leg that keeps your books clean and solid. It ties your subledger to your general ledger. And if this breaks down, your trial balance is off and your depreciation expense becomes misstated. And then guess who will notice? Your auditors, among other people within your organization from higher up. The second leg of our spider is tax compliance and depreciation laws. The tax leg ensures that your depreciation methods, your useful lives, and your bonus elections are compliant. And this is also where the OBBA comes into play because a lot of it is driven by place and service dates. So one wrong move and you can literally overstate your assets. Or, and I've seen this happen time and time again when there's miscommunication in systems, in people, in processes, is that we often leave deductions on the table. The third leg is procurement and purchase orders. This is where assets start, but procurement doesn't always communicate what's capital versus what's expense. And so there's a disconnect of communication. If there's no integration between these systems or spreadsheets or workflow or processes and procedures, then items can't get capitalized. And if they do, they're either late or they just get missed altogether, which is obviously not where we want to go. Number 4 of the spider is capital projects. My absolute favorite part of fixed asset lifecycle is CIP, construction and progress accounting, how we track it, how we mobilize it, how we manage it, how we communicate with others across our organizations. This is where an asset actually starts, right? If you're not clearing CIP on time, or if projects aren't capitalized correctly, where we're weeding out capitalized versus expense, if we're not componentizing assets down to the details, then you're carrying dead weight on your books. And furthermore, this is where we get back to some of our other legs of our spider, where we're talking about assets that are not getting capitalized or not with the right place of service dates if our CIP is messy. Number 5 on the spider is our inventory and asset tagging. We obviously need to know where these assets physically are located within our organization. So this leg ensures physical assets match our system of records. If we miss a disposal or fail to tag a new piece of equipment when it comes in, which I often see if there's no process or policy in place, then suddenly the depreciation and the audit trail are completely disconnected from one another. And that opens so many different bags, right? Which we don't want, especially when we're scrambling at year end already. The 6th leg of our spider is reporting for finance operations. This is where the leaders look to make decisions. If you know that your data hygiene of your fixed assets is 90 to 99% accurate, which is a pretty good standing in my terms, actually, over the years. If you could literally say that your data is so accurate that is so good when it's reported back up to FP&A or any of the C-level, your controller, your CFO, because what they're doing is they're taking that data and they're looking to see if everything's complete, and it can ripple effect across their budgets, their planning, their performance metrics. So what kind of capital are they going to designate for the following year or years on these different projects or new projects coming in? So it's all a piece of the puzzle of this spider. Number 7 is ERP integration and automation. And some people are like, does this play a role? Yes. How are you tracking these? My secret sauce, or my superpower, if you will, is problem solving. I love to go in and look at the whole web and see where those holes exist and fill those as much as I possibly can with automation tools, because this is your connective tissue between all of the things fixed assets. If your software are spreadsheets, and I know there's a bunch out there with spreadsheets, we love them, we do, but they're not always sufficient and efficient for us or our customers. And so if you're not talking to your ERP, or if you're doing a lot of manual work, then you're leaving room for human error, lost time, and lack of reporting requirements. Spreadsheets are awesome, but they're not a communication tool either, right? And then number 8, a lot of people don't think about this one, and they miss the goal on this one a lot when they're talking about fixed assets. And if we look at the future vision of our fixed asset management and life cycle and how we want to approach our year end, our quarter processes, is audit and M&A readiness. Even if you don't know and you're a user, you may not even know that an M&A may or may not be possible or coming in your future, but you still want your data to be ready for that. And you definitely, most definitely want it ready for audits, right? Internal, external, SOX or not. This is the final link that gets tested under true pressure. Whether it's for an audit or merger, fixed assets are always scrutinized. And sometimes they're not if it's immaterial. But I'll tell you what, because of the OBBA in effect, that's what's going to happen. They're going to start looking more at your fixed assets and how they function and how they move and how they're reported and how they're tracked. It's because they want the visibility. So you need to get the visibility. You want to make sure that your data is defensible, right? So you want to make sure that it's clean, it's reconciled, it's traceable, it's documented. So you have no problem defending your data to whoever comes knocking at your door asking. So each one of these links may live in different departments across your organization, right? But they all affect the same body of the fixed assets. So when they function together, it's beautiful. I've seen it happen. It's beautiful. Everyone has visibility, everyone has control, and most of all, everyone has confidence in their data. And when they don't, that's when the web really falls apart. So let's dive a little deeper and talk about the real gut of why we're here. Data hygiene. So this is the number one reason fixed assets become a liability instead of a strength, is the data hygiene. But we see this everywhere, right? We also see it in our CRM. Sometimes we see it in our AP or PO, where we just don't trust in the data. And fixed assets are really no different. When was the last time you did an inventory? When was the last time we double checked those invoices, the descriptions? We went out and said, does this look like a building remodel? When was the last time we put that line item under a magnifying glass and dug deeper and said, oh, these $2 million line item is actually should be broken out into personal property where we can get tax expense, not just 39 years of the slow roll. So we really need to think about our strength of our data hygiene. And when we say data hygiene, we're not just talking about neat spreadsheets, right? We're talking about everything. Do we have the right assets? Are they in the right place? Do they have all the right details? I've seen time and time again where customers have in their spreadsheets or even in their system where they have a few data lines that represent the asset and truly describe it. But if someone went out to go find it, they have nothing to go look for. So you always want to take advantage of all these different pieces of fixed assets that fully describes them. And if that doesn't look good, then that's also part of your data hygiene. Okay. And why is this so important? It's because when you have the right assets in the right place with the right details and being able to prove it when tax, audit, finance leadership comes asking, or even when you particularly are trying to find something, or somebody else comes to you and says, I have this asset I want to dispose of. How do you know in your system, in your data, if it's not clean, which asset you're truly disposing of? So what kind of these things show up the most that I see over the years are duplicate entries. I see those a lot. Or ghost assets. And ghost assets aren't just necessarily those that haven't been inventoried, which means equipment that's been disposed of physically, but it's still depreciating on your books, right? Or worse, assets that don't even exist. I've seen this a lot too, but are carried on your books year after year, which also affects your insurance premiums, your property tax reporting, and all these different nuances, again, that people don't really think about when they're thinking about the data hygiene of their fixed assets. So I also see place and service dates that don't align with invoice records. So assets are usually assigned to the wrong category or cost center or the wrong property type, which is huge, especially if finance is inputting the data. They usually just put everything under P personal general, but on a tax world, that's completely different. So these are the things too that when we go to review our data, we really need to start looking with a fine-tooth comb. Okay. And when you start to uncover these things, that's where you start to see all these awesome bits and pieces that actually most of the time puts people in more of a tax expense, which is getting money back. So it's always worth your time and effort to spend the time. These are things that we can proactively do before we actually get to year end so that we're not in that position. So of course, what also happens is no documentation. So no invoice, no PO, no physical tagging. And that's a huge red flag in audit. I've been on fixed asset audits many times for many different organizations, and it's always the same checklist. And what they're really looking for are these things, documentation. And they really want the documentation on things that you're manually doing. So again, when we're talking about the whole spider, and I look from above holistically at every organization I come into, and I say, where are we manually doing things? And where can we fill that with automation? Because when we do that, we take 10 test steps in audit or SOX, and we eliminate it down to 2. And those 2 are typically who has access, what access do they have? And is the system itself calculating accurately? And that's it. So think of those things too when you're thinking about data hygiene. This is where most teams find surprises when you start your year-end prep. And this is where you can gain serious control by doing a deep dive now. And now I want to talk about my absolute favorite subject of fixed asset lifecycle is CIP. It's the most overlooked area in all of fixed asset management is construction and progress accounting. And I know this because over 27 years, every time I bring this up to anybody, any organization, they're like, yeah, I think we do it in spreadsheets. We do it in spreadsheets is literally 90% of the answer. And when I start looking at those spreadsheets, I've seen so many spreadsheets in my lifetime, and I'm still surprised by the creativity behind spreadsheets. And then sometimes it's no wonder we're missing when we start to reconcile and do their data hygiene when we're implementing a CIP solution. That's where we see so much disconnect that we've already discussed up to this point. So CIP is like the attic of your fixed asset system. It's where things get stashed. A lot of times they get ignored, they get forgotten, but everything in CIP has its purpose. It's a project in motion that should eventually become an asset, land in your books as depreciable. Yes, you can still keep expense stuff in there for the whole project, but eventually the whole idea is to move them into depreciable assets. So now we ask, what do we need to clean up? Good question. We start by pulling any lingering AP or PO transactions. And 9 times out of 10, I'm always surprised by how many open commitments or partially invoiced projects are still sitting idle at the end of the day, specifically at year end. Those need followed up really like as soon as you can before you get to year end, either to clear them or to bring them to completion. And this is where my famous word, it's almost like a drinking game, coffee, tea, whatever. When I say communication, ding, ding, because you really need to communicate. And most of the time where I find this lingering transactions with CIP projects is because accounting doesn't have an open communication line with the project manager or facilities, maintenance, or anybody else as part of that project. They're not talking. And that's really difficult to do if one person is manning the spreadsheet and the other person is managing something else. When you, again, go back to having these integrated systems all talking to each other, then that's where it also works as a communication line because someone can log in, see the process, see the progress, see where actual spend is, and then start making strategic decisions on either revising the due dates, pushing out the project, all these different things, right? And what that also helps is to close out and complete a CI project, because even FP&A can go into your CIP, see spend, and then they can start doing their own budgeting and forecasting to see, is this project on time? What are our vendors charging? You can start seeing analysis against this information when you start tracking it effectively. So when it's done, then you have to move it to capitalize it, right? Don't let finished projects sit in this CIP limbo that I see all the time. That delays depreciation, and it also misstates your balance sheet. Next, we want to be sure that we're inputting final additions into the correct place and service dates. People are like, Angie, this is a duh. Yeah, I see it happen every single time I review and reconcile CIP against in-service, because we see specifically at year end, that's another reason why I put it in this topic, because at year end, I'll see and review subledger data, and there's a lot of assets that are completed, and then you'll see like a huge influx of disposals and a huge influx of late invoicing adjustments to these assets. But then when we turn back around a couple months later and check in, there's also like a slew of assets that were placed in service that are supposed to be placed in service in December, but were entered in January and February. And then that actually plays a huge role for tax treatment. And I see it all the time, where finance is trying to clean up for their year end and trying to do their best they can because they're scrambling at year end because they don't know what to do. And then all these APs and POs come in, these late invoices come in and payments and assets, and then they're cleaning up because they're doing it after year end, not during or before year end. And this happens a lot. And what happens when we do this is the next one, which is crossing fiscal place and service years, which is a really big problem for tax depreciation. It may not affect finance as much, but for tax, on this side, you can be missing out on different bonus elections based on place and service dates. You could be missing out on elections that you could have used for that year, right, for tax expense. So these play big roles, and these are things that we should always be mindful of. And finally, attach documentation, right? Don't forget this paper trail. Attach as much supporting documentation as you can: invoices, purchase orders, approvals, project close forms, disposal approvals. Auditors love that, but so will you and your team when you have to look back next year, 2 years from now, for property tax purposes, for insurance retrieval. Who knows? There's always something, right? So CIP is where you can clean up a lot of these issues before they turn into your reconciliation problems or depreciation errors or year-end issues later. So treat this definitely like a checkpoint in your process before an asset even enters the system fully. Okay, CIP is where all the gold nuggets are, is what I say. So then let's move on to the inventory verification process of this checklist. Another often skipped step that can lead to big problems downstream. And this is where you confirm that what's in your system actually really truly exists physically in your real world, and vice versa. So you want to start by comparing your system records to physical inventory on the floor. And this is where a lot of discrepancies show up. Ghost assets are real. We hear about this all the time. I think in 27 years, we've always used the term ghost assets. They do cause a real problem. They cause a real problem outside of just your subledger. They also cause problem for tax depreciation. They also cause problem for insurance premiums and what you're going to get back. They also cause problems for property tax and property tax assessments. Nobody wants that. So these are big things. And a lot of people ask me, Angela, I don't have enough time or resources to sit here and do a physical inventory of all my assets. And that's okay if you don't want to outsource that to a team that can do that. What you can do is, I always call baby stepping. Has everyone seen that movie, What About Bob, where he baby steps? One of my favorite movies. And that concept exists too in fixed assets when you're thinking about inventories. You can literally take groups of your assets each month and have a team member or yourself go out and just verify. This is a very good process you could adopt to do it monthly so that it's not a big deal. And in reality, I would start with those assets that move the most. If you're in manufacturing and you have large ebony that's bolted to the floor, obviously we know it's there, right? If you want to be practical about doing your baby steps, then a practical solution would be to group those assets together if you can by those that are the most actively movable assets, and then just go identify and verify those first so that you can get some of it done. It's better to do some than absolutely none, which is what I still see today, which is like crazy for me. But this is where those assets that were disposed of months ago may still lurk on your books, and you might actually even see them out there even if they were disposed. That also happens. So these are things that we definitely want to clean up before year end happens. So next you want to identify, again, those disposals or additions. This is also where we're missing depreciation on these ghost assets. So we're not just talking about those that have been disposed and still in our books, but we're also talking about those that we've purchased and we haven't put on our books, or a client has purchased and hasn't put on their books. And that happens a lot, I see, when there's a disconnect between their systems, their processes, their communication, or also I see this a lot when they have too much volume and they don't have good processes in place to accommodate the volume of data that comes in, like grocery stores, retail. They often struggle with the volume, especially if their systems are so disparate and disconnected. Okay, so make sure newly acquired assets are discovered, are tagged, are entered into the system properly. And if it doesn't have a tag or an ID, it's going to be really hard to track and reconcile or verify that in an audit later. So if people are usually using the system number of an asset, if they're using a system to track that, but that is incorrect and bad practice because that system number can be deleted. And we'll go into another slide shortly that talks about that again, why not to do that. So you really want to have that verification, a real tag, right? That really does identify that asset no matter where it goes, who's looking for it. And keep in mind that people on the floor will know what that asset is by its name and its use and function. Where in finance, we know what it is by the cost, right? So we want to make sure that we're talking about the same asset. And when you use barcode numbers to adhere, then we know and we ensure that we're talking about the same asset regardless of our nomenclature. So this verification is your last chance to catch those physical inconsistencies before you lock in depreciation and close out your year. So now we move on to the point where everything has tied together, right? We've cleaned it up, the subledger, the general ledger, and this is where the truth really shows up, is where we reconcile these two together. So you want to start by tying the fixed asset subledger to your GL, right? Obviously, everyone knows that. But if your numbers don't match, then you're going to have to go back and look a little deeper to clean up your data. You're going to hear about it if you don't, right? From your controllers, your auditors, your CFO, anyone who dives in to look at this detail. So you want to make sure that you resolve any of those variances at this time. And this could be a timing issue, right? Things we already mentioned, missing journal entries or assets that were capitalized in one system and not the other. And this is where I see this disconnect specifically if internal finance is managing the subledger based on a straight line depreciation for GAAP purposes, but tax is being held, or state or EMP or any other depreciation book is being held somewhere else, or a different spreadsheet or a different system, or externally third party. These are where we see huge problems within the data. And over all these years and all these spreadsheets, I can honestly say with 100% accuracy that every spreadsheet that's come across my desk, not one has been accurate. And it didn't matter if it was 250 lines or 250,000 lines. There was always inaccuracies in spreadsheet data, specifically when the depreciation books are separated from one another. So this is where we see a lot of these mistakes. And so then you also want to make sure that you're matching your project capital to your actual spend. Late invoicing happens in fixed assets all the time. The bigger the volume, the more you see. Specifically too, on CIP projects that have a long timeline, we always see straggling invoices that come in, or credits too. They don't even have to be progress payments. They could be a credit, something we sent back. We have to look at that, and we really have to be diligent about going after that, being a little detective. So we want to make sure that any mismatch should be addressed before year end, because if it's your year end, chances are, and I know not everyone's on the same year end, but a lot of people finish out in December, and it's not only you but the people, your vendors, are also scrambling at year end. So if we can be proactive and start doing that now, that due diligence now, the better chance we also have of a response from our vendors before year end. It should definitely be part of your checklist no matter what. This is the most high pressure parts of year end is fixed assets because a lot of people aren't doing it correctly or efficiently. But when we do it right, it's also one of the most satisfying because then everything lines up, you're ready to move forward, and you have confidence. And you know that any years moving forward is going to be just as clean and smooth. So let's talk about what should be happening before you hit that depreciation run button. So we've covered a lot already, and we're now just getting to thinking about hitting the depreciation button. Okay. And it starts with, again, proactive communication. So yeah, you want to lock the prior period, but that's right at year end before we have depreciation. But before we do that, we want to make sure that our year end date activity is frozen, right? That we are done. We've cleaned everything up. We don't have any last minute entry sneaking in because we've done that ahead of time. That's what we're talking about. So we're done prepping reports at this point. But more importantly, at this point of the game, now is the time to meet with your tax and state teams. People say, oh, Angie, I'm always under the gun. We always want to communicate, there's that word again, with our other teams that take this data and run with it after we are done. It's so much easier if we include them in the conversation now than later. So you want to involve your tax and your state team. Okay. You want to involve someone if someone's doing property taxes or insurance valuations. Maybe it's treasury departments that are handling this. You may even want to wrap in your FP&A since they're doing budgeting and forecasting, usually around this time before the year starts and rolls over because they have to get approvals. Everybody, every leg of the spider needs to involved at this year-end process, just so that we all know our responsibilities and we all know how we want to see the data. Then you're not going back and forth. And then when we're involved, for me, when I'm in it, I know everything about it. If you ask me 3 months later, I'm going to be like, I don't know. I'm going to have to spend another 10 to 20 hours investigating to find your answer. Whereas if we're all involved in communicating now, I already know, I'm front and center. So don't assume that this team will just take what's in the system and run with it, because that's not the case. Ask early, what do they need? What reports are they expecting to see from your work if you're in finance? What custom state treatments or bonus calculations should you be flagging as a user in preparation for the handoff? Review with these departments Section 179 and bonus depreciation eligibility, specifically too with the OBBA. Look at the data together, and if you're using them and you're properly reflecting them in your tax books, right, and your entries, making sure that the tax books, state books, if you are managing them side by side or externally, making sure that all of the values add up, like no additions are being missed, which isn't always the problem. What I see the problem and the disconnect is most of the time, honestly, is disposals and adjustments, right? They're always missed. They're always disconnected. They're always irreconcilable. If we involve everyone now, then we can see we have some touch points. This is where we are. This just means that we're not scrambling later. A question for yourself today, either you're a user, a CPA who's taking care of client work or whatever, are the systems that everyone's using, are they flexible enough to take care of all this stuff so that they're not scrambling later? That is the big question everyone needs to pause and ask. So you match all your books together. If they don't align, and most of the times they don't, again, this is the moment to find the differences, reconcile, and again, document. And don't forget to address state-specific rules, because states, and often they do, decouple from federal depreciation. So if your system tracks a state book, make sure it's updated now. Again, not after tax circles back around and asks for all of this stuff. Because here's the thing. If your first real tax communication happens after you're in close, like I just talked about, right? You've really already lost your efficiency. So proactive equals partnership and reactive equals rework. And nobody wants rework. So this is one of the biggest gaps I see across all companies is when finance, tax are running separate races for the same finish line. And I think it's up to all of us today to try and fix that, to make it so much easier. So here we are finally ready to run depreciation, right? But let's not treat this as just another system step. This is the result of everything we've cleaned, verified, reconciled, and reviewed so far to this point, right? So only after you've completed all the data hygiene that we've talked about, the CIP cleanup, inventory validation, book to GL, reconciliation, involved our other team members, then you hit run. And remember, you're not just running one book. We're talking about year end, right? So you're going to run GAAP, depreciation, state, any other depreciation books that you put together. I see earnings and profits being put together a lot, a separate book for ADS. So any of these, regardless if it's external, internal, make sure we're all doing it because we all have different rules, methods, treatments, but we're all working off the same data. So before you do anything, pause again to ensure accuracy and ask yourself, do all final additions have the right place and service dates? Are my disposals reflected properly? Is bonus depreciation and other options applied only where it's allowed? And are any other adjustments reflected equally across all relevant books? This is the moment to lock it in, right? Because after this, we run depreciation. Now we're preparing reports. The reports take time too. So you want confidence in the output. All right. This is a big milestone. It means you're close to ready to move forward. Your reports are ready to run, and your tax can stop chasing you for answers, which happens all the time, right? So let the system or a system do the math. Let your process and policy speak for themselves, right? So always be thinking proactively. The next step to this year-end process is obviously reporting and filing. It's time to do what everyone's waiting for, right? Reporting. So let's walk through the core reports you should be pulling at year end and what each one is doing for you. First, we always run a depreciation expense report. If you're in spreadsheets, you should be running something very similar to this and formatted. If you're in spreadsheets, please start thinking about something else and let some system do the work for you. This is what a controller or CFO will want to see right away, right? It'll be what you want to see right away when you're reconciling. Tells you what to post, what's changed, and whether the books reflect reality or not. Next is a fixed asset summary, or what we call a roll forward. This gives you the big picture of beginning balances, additions, transfers, all these different things that have taken place, and your ending balances. So it's really like your life cycle in one big viewpoint. And then you'll also want a clean report of all disposals and transfers of that detail for the current year that you're in. And you'll want to lock that away. PDF, Excel, all of these things, both versions, because different places, auditors or internal, will ask for one or both or one or the other. So always do two different versions. And then for the tax piece, if you're managing the tax, that's when you start pulling things for your forms. Certain fixed asset systems can do the tax forms for you. These are some things that you'll want to definitely print out and hand off to your tax advisory group for your filing. And finally, check your net book value book. I love a net book value report because it just gives me the whole overlay of everything. Usually, I always run them across all the books just so that I have a different viewpoint and perspective of reporting and reconciling going forward. And this just makes sure that everything is aligned. And then I guess one final check to see if they're not and why. So they're not just paperwork, they're like your finish line. They turn year-end effort into clean, defendable numbers for you, for internal, external partners. And again, make sure you do both PDF and Excel on these. We're almost at the finish line here, but this step is one of the biggest things that gets missed more than you would think, which is archiving and backing up your data. And these aren't just IT backups that I'm talking about. That should be already happening in the background, but these are a little different. So this is by exporting your reports that we talked about already in PDF and Excel, whatever you've generated. So depreciation, your roll forwards, your tax, everything. Make sure it's complete. And this matters because in some systems, there's no point in time reporting. In some systems, I won't name them, when you do a disposal, when they flip into the next year, that information gets archived. The original information of those disposals for prior years gets removed from reporting. And that's not awesome either. Or what I've also seen in other different systems is where someone transfers an asset, and what happens in the back end of the system is that they dispose of the original asset and then they create a new asset for the transferred piece. And then the other piece gets removed again once your year end flips into your new year cycle. And a lot of these different systems or even spreadsheets, you should lock them down, put them out into a different version, name them cleverly, not book 2 year end 25 final. Use some good nomenclature here in naming conventions, but you want to make sure that you're storing this information so that you can go back. We still have 3-ring binders, I know, and we're in this huge digital age, but we still need these copies for other things. It's just like storing all your receipts for your personal taxes. It's very similar, right? So document all this stuff, document the adjustments for sure, because that is one of the biggest questions. Your future self and your auditor and your tax advisor will thank you if you do all these different documentation storings and documenting everything along the way. So store it in a secure, centralized place. I know, I wish I didn't have to say this, but I see it still. Don't put it in someone's inbox. Don't put it on your personal computer. Put it out there on a shared drive. Don't put it on a drive that gets wiped and that has an automatic archive on it. Go put it somewhere central that people can locate it later, that you don't have the only rights to, but the people within your team that have the rights to view this stuff have those rights to get it. And then do a backup. So leave a clean trail behind. You will love it later. You'll love yourself later, and everyone will be like, yes, with a strategic win to finish strong. So let's wrap up the technical part of this webinar with a few quick wins that can set you up not just for closing the year, but also transforming how you manage these going forward with all this information we talked about. So first, align ownership. If fixed assets are still treated like a shared inbox or whoever has the time, it's now the time to shift that. Put in processes and policies. Look at the holes. Where can we automate? Where can we make this easier for ourselves? Be proactive. Ownership drives accountability, and accountability drives the accuracy in your data and processes. Second, clean up your workflows. So take note of what felt clunky or reactive this year. What steps that were manual took too long? Again, where can we automate? What reports do we have to rebuild that maybe a system can build for us? What are the reports that tax is asking for? Let's put that in for next year. We forget about being proactive for the following year. So the next step that I would suggest is schedule a Q1 post-close review with all of the teams. Put it on the calendar now while you're thinking about it. Meet with tax, finance, audit, review what went well, what didn't, and how can we make these improvements and be collaborative. And then finally, plan a mid-year inventory. So again, we talk about inventory, but a lot of you are like, oh, I haven't even done that and I don't have time. That's okay. You can still think about it and plan it for next year so that it's clean next year. So this is your chance to turn fixed assets into strength and not a scramble. Once you've done all this hard work, you want to keep that momentum going. So we've walked you through this whole leg of this web. You've seen where the breakdowns happen and where it takes to untangle them. If you wait until next quarter to clean it up, it'll come back to haunt you. So start now and finish strong, because once your system's clean, your reports are aligned, and your teams are in sync, fixed assets become what they're meant to be: fun. And at the end of the day, if you're still stuck in spreadsheets, Sage Fixed Assets has the full life cycle automation for you, which can also integrate to your ERP in the front and in the back, meaning AP or PO, back to your GL, so that this automation and these different manual processes and reporting can actually be automated and work with you and for you. And also will reduce those steps that we talked about for auditing, right? And it'll just clean up your data and keep all the work you did to clean it up going forward. Dirty data in, dirty data out. But if we clean up our data and put it into an awesome system that helps us along the way, then we have our confidence within our books.
So the first question is, we've identified some ghost assets in our books. What's the best practice for removing them without triggering audit issues?
The best thing that you can do is go and identify all the different information about that and then try to clean that up in your book. And you can do it as a current. I wouldn't go back. Let's say it's been a year or two that you should have disposed of this asset, let's say a disposal, but it's still in my books. Go when you're in your current year, just go and dispose of it of this current year so that you can have that, make an adjustment, and then have that adjustment occur in your current year. And then anything that you need, you can do a manual adjustment to your GL. That would be the best, so that you're not going, across multiple fiscal years, as I see that a lot where people are trying to clean stuff up, but they're going back in time. You don't want to go back in time, especially if it's just handfuls of assets, because you don't want to go through all that paperwork from a tax perspective. But going forward, you want to just clean it up as of current through or current year information, and then make those adjustments in your subledger and then in your GL.
All right, thank you, Angie. If we haven't been keeping up with fixed assets cleanup all year, what's the most important thing to tackle first before year end?
Great question. I would say look at your CIP balances. Is there anything in there that can be moved over? Also, what comes through CIP, if we're doing it accurately, is checking all of those late invoices that we talked about. So we can capture, if we start with CIP and what's being moved and not moved, and reconciling that to our subledger, that will have the biggest impact if you start there.
So, one question we have in regards to commercial real estate acquisition, is a third party cost segregation study recommended as opposed to internal cost allocation?
Yes, I love cost segregation when it's done accurately. And also, if you have a third party do it, then they can defend you typically in anything that property tax might want to come and assess you about, or if IRS has any questions about your elections and deductions or the movement. Maybe you might have to do a 3115, which is a change of method. Depending on how much the cost seg finds, it's always good to do a third party because of that piece, which is the documentation piece of that they could defend against any other questions that come after you do that. If you do it internally, people are going to ask. They're just going to ask. You're going to get questions later. Yeah, great question.
Oh, great. The next one is, we know we should be tagging assets, but it feels overwhelming. Where's a good place to start if we've never done it before?
It can be overwhelming, and it gets overwhelming because a lot of people do it wrong. They take their subledger and they print it out and put it on a clipboard, and then they start to go find, like looking for a needle in a haystack. Specifically, too, if they don't have a good name or just a description for that asset in particular, that it's very challenging and it take a long time. The fastest approach, I'll give you the fastest approach, and then I'll give you the best baby steps, which we talked about earlier. The fastest approach is to do a Florida book. So go out, get your tags, inventory everything that makes sense. You want to go with a plan. Don't just willy-nilly, because that also makes you do rework. So go out and then start tagging everything, and then bring it back and then start to reconcile against your book. That's the best approach if you've never done one. The small baby steps to get you excited and jazzed about doing it is, like I said before, group your assets together by those that move the most movable assets, right? Those are the ones you really want to identify where they're at, because if you have multi-locations, multi-jurisdictions, if you have multi-country, if you're global, you want to know where these assets are, because it really plays a different role, not just in your financial statements, but in property tax, state tax, insurance. There's different nuances between all these different districts and states and counties about different write-offs or expenses or treatments, depending on where it's physically located. So I would start with those first. Those are the most impactful.
Great. Here is how you would reach out to Angie. And with that, I will say thank you, Angela, so much.
Thank you.